back to the Beyond Wealth Advisors Economic Update. I'm John Cleaver, CEO and Private Wealth Advisor, and with me is Scott Hawker, Financial Advisor. Welcome, Scott.
Thank you, John. Thanks for having me today.
Absolutely. Well, today we're going to unpack a pretty eventful stretch out of Washington, D.C. We've had a government shutdown, new tariff threats, flood of policy moves, all shaping how investors view risk heading into the year end.
That's right, John. It's been one of those weeks where policy headlines could easily rattle markets, but so far, the markets have been surprisingly calm. Today, we will walk through why that is, and more importantly, what it means for investors trying to read through the noise.
Yeah, there's been plenty of noise for sure. So where do we start? Let's start with the obvious, the government shutdown. Started on October 1st, we're in day 9. But honestly, unlike past shutdowns, there's no real catalyst for resolution. Historically, these episodes have been more of a headline risk than any type of an economic risk. And the markets tend to stay pretty resilient.
Exactly. What makes this one unique, though, is how targeted it's been. The administration froze $18 billion in infrastructure funding for New York and another $8 billion in climate-related grants across several states. So this isn't just about federal paychecks or TSA lines. It's about reshaping spending priorities as a whole.
Yeah, you're spot on there. It's definitely different this time around. So where should investors take note? How does it impact them? Well, we know there's going to be delayed data releases. That's going to muddy the short-term picture for sure. But if that weaker data comes through, it could actually increase pressure for the Fed to move faster on rate cuts. So ironically, the markets might view this as a near-term positive if they see more liquidity coming into the market.
Okay, so let's shift to trade. Tariffs are back in the spotlight and the details are getting complicated. The administration rolled out new semiconductor manufacturing requirements that tie U.S. production directly to import levels, the so-called one-to-one rule.
Yeah, I think this one really caught a lot of us off guard maybe, and something we want to keep our eye on. It means companies would need to produce as many chips here as they import from overseas. Now, that could certainly mean a boost to domestic capacity, but it adds cost, it adds complexity, and in the short term, it could really put a drag on that tech supply chain.
That it could. And while the movie tariffs made
fun,
headlines, the real story is the ongoing China, Taiwan, and South Korea negotiations. The U.S. is pushing for what's being called soybeans for semiconductors deal, which is trade relief in exchange for agricultural purchases.
We always have to come up with a phrase or something, right? So what's the bottom line for investors? I think that's what all of you want to know. Well, one, tariffs are here to stay. But they're shifting. They're shifting from a punishment to more leverage. Companies that diversify supply chains, that already manufacture stateside, they could really be the winners over this time ahead.
Okay, so let's shift to banking. For the first time in nearly 2 decades, the environment for banks and financial mergers is actually favorable again.
Yeah, this is huge. So the Fed eased some of the capital requirements for banks, and the regulators are signaling, let banks be banks. And that attitude means more lending capacity, more buybacks, potentially more merger activity across community and regional banks. I kind of think of it as money in motion, more money in motion.
We've been saying for a while that bank consolidation is inevitable, especially with tech costs and compliance rising. This week's policy tone just accelerates that timeline. So for investors, high efficiency and better capital return could be an upside theme heading into 2026.
Such a trickle down too, right, when the banks are being aggressive. Well, another big topic is energy. Energy policy has been in the headlines for a while now. The administration rescinded $8 billion in renewable energy grants across 16 states. Certainly a setback for a clean energy project, but it's a part of a bigger pivot toward what we're calling AI-ready infrastructure. What the heck is that?
Right. That's the interesting overlap here. Big tech and big energy are now working together on grid modernization. Companies like Amazon, Google, Microsoft, They're proposing voluntary energy demand programs to stabilize power grids as AI data centers expand.
Yeah, it's really incredible to watch this unfold. So it's a reminder, really, that AI isn't just a software story. It's an energy story, it's a construction story, a materials story. The companies that supply or build the infrastructure for fiber, grid storage, transmission, they all stand to benefit as much as the AI firms themselves. It's really fascinating.
Absolutely. And then there's crypto, right?
You had to go there.
Yeah, maybe the biggest policy shift of this week.
Right, absolutely. Yeah, so the Treasury just eased corporate tax rules. So unrealized capital crypto gains won't hit the corporate minimum tax. That removes a major hurdle for institutional investors, and certainly that's significant.
And to that, the SEC gave the green light for state chartered trust companies to act as qualified custodians. That means mainstream firms can now hold digital assets under existing investment advisor frameworks.
Yeah, it'll be interesting to see how that impacts us going forward and ultimately our clients. So between the new custody rules, new tax clarity, big names moving into the crypto access space, we're watching a normalization of the digital asset space. And for investors, what that really means is it's shifting from just speculation to now more about how does this integrate into a traditional portfolio.
Okay, so John, if you had to boil all this down, okay, the shutdowns, the tariffs, crypto and energy, what's the investor takeaway heading into Q4?
Well, if it hasn't been an interesting year already, certainly Q4 is going to keep us on our toes. I would say this, Washington's back in the driver's seat. No shocker there. But markets are showing tremendous discipline. This noise is going to impact those day-to-day sectors. But if you focus on long-term fundamentals, innovation, earnings quality, positive cash flow, those companies are really going to excel in this upcoming quarter and potentially next year.
Well said. The short version, stay patient, stay diversified. Don't mistake political headlines for economic reality.
That's amazing what you just said. Don't mistake political headlines for economic reality. So thank you for joining us again for the Beyond Wealth Advisors Economic Update. Until next time, stay informed, stay invested, and stay aligned with your long-term goals and purpose. And don't forget to reach out to your financial advisor. It's a great opportunity to do some year-end planning and set yourself up for what's to come.